So we all know what mergers and acquisitions primarily is, right? We know that mergers and acquisition is one of the most dynamic and I think one of the most influential sectors you can say in the entire world of corporate laws, right? So corporate laws, particularly, we understand as capital markets, as private equity, and M&A is another major area which we have understood in last 1 year primarily, and even for people who are new, right? For your understanding, mergers and acquisition is one of the most prominent sectors I can say in the field of corporate world. Okay, now we keep reading about M&A, we keep reading about any merger, any acquisition in newspapers, social media channels. Maybe if you guys are on LinkedIn, right, you would have seen a lot of firms and a lot of partners posting their deals, right, around an M&A transaction, right? So what particularly, just M&A means is it's merger of two entities, I can say, in a very layman language, where maybe let's say A entity is merging with B entity. Okay. The purpose of merger, or maybe A entity acquiring another entity, is also part of M&A transaction, right? So all purpose of all this merger or acquisition, I could say, is primarily to maybe have more reach in the market, okay, to maybe have a better growth in terms of two entities working in a similar sector. And this is very basic example. The nuances of it is something which Abhishek will deal with. Okay, just for your understanding at a very layman sort of understanding, M&A is anything to do with where two entities are maybe merging, or maybe one entity acquiring another entity, okay, for the business growth, I could say, right? That is the very basic understanding one could have, right? So what M&A deals with? It deals with mergers, it deals with acquisitions, it deals with amalgamations, it deals with the JVs, right? It deals with takeovers. Now, takeovers is something which is another interesting aspect of an M&A transaction, which we will cater to at later stage. But what we don't understand or what we don't see is that there is more than the purpose or more than the business strategy involving around such corporate restructuring, which is at play, right? In each M&A transaction, okay, there is a complex web of legalities. There's a lot of compliances we see. There's a set of rules and regulations we have to comply with. And the most important aspect, especially from your perspective, guys, is due diligence, right? Which in my view is the most important leg of an M&A transaction, and responsibility of ensuring that diligence is perfect is primarily on the shoulder of you guys. Because when you start in a law firm, right, you are not expected to work on maybe let's say a definitive document, maybe a merger cooperation agreement, let's say, or maybe a term sheet, or implementation agreement, or maybe a share subscription agreement, or a share purchase agreement. These are definitive documentations which are negotiated, which are uh, drafted by lawyers, maybe little at a maybe at a little senior position, right? Who have understanding of transaction, who have been involved in such transactions in past. But you guys are primarily going to work on due diligence aspect of an M&A transaction, right? And that is something where you need to be and why so the way we are going to do this session and the way we have designed these sessions for you guys is to make you understand nuances of all such transactions, whether it's a merger, whether it's a acquisition, whether it's a asset transfer or business transfer or a joint venture, maybe any of those corporate restructuring transaction you could see, right? You should have understanding of the nuances, so that there is complete clarity of the requirements, this complete clarity of the process, and most importantly, understanding of the purpose of your role in a transaction and your work in a transaction, right? So once you have a understanding at a bigger picture perspective, you will be able to do much better job, or I could say you would be able to justify the work you have been allocated in a best manner possible. Okay, so that is the idea, and that is the way we have designed these M&A session, guys. You should not look at diligence as the I think boring or laborious or templated work, which I think is the general understanding amongst young lawyers, young associates, which Abhishek could agree. On which Agrima also is here, guys. By the way, Agrima is a senior associate at uh, Consortium Legal. Okay, and she has also worked at in a lot of M&A transactions, especially in private side, and she has experience of around, I think, more than 5 years, Agrima, right?
Yes.
So, so I think both Abhishek and Agrima could agree on the fact that a lot of you guys, a lot of young lawyers, right, they see diligence as one of the, I think, not so exciting area of a transaction. But trust me, guys, it is the most crucial leg of a transaction. So maybe what Agrima must be doing in terms of negotiating with counterparty, or what Abhishek must be taking a call with the principals on whether to do a transaction or not, is dependent on your diligence. So ultimately, what your findings are, right, in terms of doing diligence on the target company, or the maybe entities involved in merger, right? Whatever your findings are could be a deal breaker. Okay, so life of a transaction depends on what you do in the beginning. So that is why understanding of what Agrima does when she is negotiating with the counterparty, or what Abhishek is advising in terms of to the clients, right? You should have understanding of all that. If you don't have that clarity, if you don't have that picture, right, what you would end up doing is what any I think AI or robot can pick up in future, for sure, right? So that is where your, I think, uh, importance kicks in terms of you have that understanding of applying yourself and figuring out issues, and maybe give a better advice to your seniors like Agrima and Abhishek, telling them, listen, we see this as an issue and this could be a deal breaker, right? And that is why importance of diligence is, I think, the most crucial thing, and you should also take it as a important factor. Now, this is my bit to you guys. Obviously, I will pitch in as and when required. I would leave it to Abhishek to start the session. And today, what we will cover primarily is that, like, what is M&A? Okay, types of M&A, types of transactions, common aspects. When we talk about M&A transaction, what is the common aspects amongst each of those, and what is the rationale behind doing these transactions primarily, right? So these are the primary areas we're going to cover today. And tomorrow, me and Agrima are going to cover on the case studies in terms of whatever has happened in recently in terms of major transactions, so that you guys get a little bit understanding about how these transactions have been constructed, right? So Abhishek, over to you.
Sure. Thanks, Narayan. Hi everyone. So I could see a lot of faces, but if you can get an idea about like all are the law students, or probably we have the people who work in the law firms also.
I think other than three of us, Abhishek, me, you, and Agrima, rest all here are law students. Pratyush here has been working at SNG for last 1 year, right? Um,
And
I
Chavi,
think other than that,
Chavi
everyone
is there.
else, Shavi is working with you only. So Shavi, to you know, Shavi ditched us after she started working with you. So
Okay.
rest, I think all our students here. I don't. Nandan has just started working at Grow. Okay. Uh, Grow is a fintech where Nandan has just started working. I think rest all our students currently. Yeah.
Okay. So hi guys. Uh, any idea like I believe because we are having this session, so you would have understood about like, or you would have done some kind of an understanding beforehand about what is M&A, how you're looking out this kind of an M&A, or is just about like, okay, M&A, people fantasize about this name, right? M&A, but practically, have you heard about, you did any studies like a baseline, anything, any one of you guys? So we'll pick up someone like, so Ananya.
Yes, sir.
Yeah. Any idea about M&A?
I haven't practically like worked in any of the teams. Obviously, like we had a couple of PE sessions earlier on in the master workshop. So Like there, I think we touched upon like mergers and acquisitions a little bit, and like what sorts of things would be diligenced. And I believe that some of the main like definitive agreements and like the term sheet and everything is something that I would assume would be common in both areas. But beyond that, I haven't really worked with an M&A team.
Okay, but you don't have any understanding about theoretical understanding about M&A. What is M&A? Where it is defined? What stands for M? What stands for A? And like basic. I'm just asking basic.
Right. So right, the M stands for mergers and the A stands for acquisition. So we had discussed this earlier that in a merger, for example, a new third entity would be created versus in an acquisition. It's like an arrangement between two existing entities where one entity is basically acquiring the assets of another. So
Yeah.
that's sort of basic understanding I have.
But do you think that merger is defined somewhere?
Uh, I haven't come across it, and I doubt it because most transactions that we've come across have all been like very contractual, like contractually defined more than it's been like some
Okay.
legal
And how about acquisition?
document.
So from an acquisition point of view, is it defined somewhere?
I haven't come across a legal definition anywhere.
Okay.
Anyone else who wants to
Yeah, I think Deepak wants to
yeah.
say something.
Sir, merger as specifically is not defined anywhere, but amalgamation is defined as Income Tax Act,
Okay.
Section 2(1)(b).
Okay. And what do you mean by
And
amalgamation?
basically, two entities coming together for building synergies, like for a project maybe,
Okay.
or maybe for technology or infrastructure.
Okay. But okay. And how about acquisition?
Acquisition is when one entity consumes the other one, like takes over it, like the whole management.
Okay. So I think the understanding of M&A practically is very basic. I would say from what I could gather of when I had a discussion with Deepak and other guys. So practically, so if I have to say it from a layman point of view, merger is not defined anywhere practically, right? So merger is basically merging of two entities. Practically, it could be in a form of which we tend to follow a process under 230 to 240 of the Companies Act, which we term it to be amalgamation. Practically, that's the concept. And if I have to talk about, I personally call this M&A to be ANA. Basically, it's more of an acquisition come amalgamation. That's my understanding of M&A, right? Because amalgamation is something which is defined, right? And practically that is something we do it under Companies Act and probably following the other legislations under the law, right? If I have to talk about acquisition per se, acquisition is not something which is purely defined that you acquire something and you get something, right? It's more of a commercial word which I have heard about, and it differs uh, based on the transaction, I would say. So if I have to see, so let's take an example. There is a buyer, there is a seller, right? What is the intent of a buyer that itself first talks about that the kind of acquisition it is, right? So I'll throw up some examples for you. Uh, let's take an example. There's a big hospital in India, right? And it's running multiple hospitals throughout India. They have thousands of doctors and all that, right? And now they believe that they really want to explore more in terms of acquiring more hospitals in India, right? So that's more, and what how the intent is to expand the horizon, right? So that is more of from a strategic acquisition, I would say. There is no financial interest. That's more of exploring the opportunities and expanding the horizon of the company or the particular sector, or probably the hospital or whatever that entity from a buyer's point of view in that particular region or in particular that domain. It could be anything, right? It could be a horizontal merger. It could be a vertical merger, like from an acquisition point of view, if I have to say it from that way. There's another concept also So let's take an example. Um, I am not very sure you guys. So let's take an example. There is an entity which wants to infuse capital in an X entity, right? And that the resultant equity of that X entity, like the buyer entity, would be more than 51%, right? Here, if they don't have any understanding in terms of that both are not a same sector, one is a private equity fund who is running the show in terms of making an investment in multiple companies, I would call it to be more of a financial acquisition, right? Because the motive here is of the buyer is to gain interest, majorly the returns, right? That's how we tend to define the acquisitions to be in a two broad frames. One is strategic and the another comes on the financial, right? Now the second part comes of the acquisition and that automatically falls in both sector is how we are thinking about an acquisition, right? If it's 100%, is it a 51%? It's a 50-50, or it's less than 50. It could be 26% also, right? Right. So it depends on, and generally, uh, it could be in a form of a acquisition wherein I am acquiring the stake in a company, or it could be in a different form, which we call it to be a joint venture, right? Joint venture could be in a form of forming a new entity and wherein both parties get a certain interest in that company and they carry out certain motive, right? So if I have to say it in a concept of 50-50% days, so I'll give you a scenario. So we were working on one of our client that was an Irish foreign investor. They wanted to have an acquisition in India in a form of 50-50 in order to have their brand, or probably they wanted to expand their horizon in India in terms of their product they used to manufacture in their region, right, outside India, right? And the purpose was that it will be always 50-50, right? And what they thought of coming up with a concept of 50-50 in a form of a joint venture, wherein they formed a new entity and each, the Indian counterpart and the foreign counterpart, both invested about 50-50, and how they formed these synergies. They explored the synergies. They bought all the, there was an asset, there was a business transfer by one entity, there was an equity infusion by the other entity, and that's how that entity was formed of, right? So it was a strategic acquisition, right, in a form of a joint venture, which is in a form of a 50-50, right? So we have to think it. So whenever we are working on a transaction, right? First thing we have to see what is the motive of the buyer or the seller. We have to understand that, right? Then only we may be able to jump into the any document or probably on the commercials also. Because if you are not clear with the intent, what a client is looking forward to, either it's a buyer or seller, you won't be able to work on any document. Either it's a term sheet, it's a definitive document, it's a due diligence, anything. Practically nothing you can work on that. You won't be doing justice to your client, if I have to talk about in a layman language, right? So I'm just giving an hypothetical scenario. So we were working on some transaction like in my past, and we were not very clear of what the client intent was, right? And we thought of putting out all the standard provisions in a definitive documents, like we thought of putting out an exit provisions and everything. But it was a strategic investment, like strategic acquisition. And the client was that I really don't need an exit provision. I really don't need an exit. I want some kind of an exit only in case of an event of default, or probably at one point of time, it could be a call or put through which I can make an exit, or I can ask the other party to make an exit. That's it. So the alignment, how the buyer or the seller, whoever is your client is, you have to be aligned from your commercial point of view, what they are looking forward to from you, right? Not only from a legal documents like from term sheet or definitive, but the real intent to that, right? Basis that you would get an understanding that it's a strategic or a financial. First thing, how they are looking forward to. So if they are looking forward in terms of 26% or 50% or 51% or 100%, you would be able to judge out what all things you need to capture it off in a documentation in order to give justice, like in terms of your work, what you're doing for a client, right? If I'm saying it's 100% acquisition, I need to be 100% sure on a lot of things. It could be any liability because that person will just move out from the company, right? And at one point of time, I would have to be sure that what he is giving up to me at a first instance, that doesn't result into any kind of a liability, which tomorrow I may not be able to recover from that guy, right? So there could be a lot of things which we have to think it when we are working on any transaction. So I'll take it one by one, and I really don't want to come up with any specific theoretical concept. I really want to discuss the transactions with you guys, so as to give you a real scenario, how practically, basis my past experience, how M&A I have seen in my experience. So first I'll take 100% acquisition, and in 100% acquisition, I would tend to take it in a two-way, right? One is wherein I am acquiring the entity, and that acquisition is purely a strategic acquisition, right? But there is another form of 100% acquisition, which is in a form of a acqui-hire, right? Wherein I really want to have the KMPs on my board, right? Though I am acquiring them through acquisition of their entity, right?
KMPs guys here is a key managerial personnel, just in case if you
Right.
are any confusion.
So going from a strategic acquisition, so I'll give you a small brief. So there was a big hospital in India, probably in Delhi NCR region, and we were working on a transaction wherein we were representing the seller side, and the other side is also an hospital. They really wanted to acquire that entity, right? The intent itself came out to be that one is a hospital and another is also a hospital, and the acquisition is 100%. Sorry. So the intent is more of from a strategic that they want to expand their horizon in the Delhi NCR region, right? Now, what all things what you can think of, let's make it more of an informative and probably a discussion point, that what all things you can think about if I have to acquire an entity, right, in any part of India, what all things you would consider from an 100% acquisition point of view, and specifically it's a strategic. So Khyati.
I would have to consider as to who will have the ownership and control after the acquisition takes place. It will probably be the bigger hospital that wants to expand its horizon by acquiring the other smaller hospitals.
Okay, so sorry, I didn't get you the first part. So what you are looking forward to? So what all things we would need to consider?
Yeah, who as to who will have the ownership and control.
Okay, but let's make it more more descriptive. So ideally, if I'm making an acquisition, right, and we are acquiring an entity, so I agree with your point from what we who has a control. But I think the first question comes in from a layman point of view. What practically am I acquiring of? Am I acquiring a company, or practically I am acquiring the assets of the company or the business of the company, right? So in this case, practically, if that hospital, right, doesn't have any operations in the Delhi NCR region, right, and so having even of an asset or a business, and considering the industry to be healthcare industry, wherein you need a complete hardware setup, right, in terms of from an infrastructure point of view, I practically feel that it could be that first of all, they would have to form an entity, they would have to acquire the assets, they would have to transfer it off. It will result in a lot of issues, right? And the simplest, what I feel it to be, that I'll just And I completely agree with you in terms of finding of the ownership, but practically, if the entire hospital has been run by a company, so ideally we would have to assume, and probably we would be able to do it through a due diligence also, in terms of finding that how who is running the show, right, and who owns the control, right. So from that point of view, I think acquiring the shares of that company would be the first motive in terms of acquisition, right? What would be the next step for us, right? I think Ananya was raising hand, so I think I'll just put on to Ananya.
Uh, Sorry, there's some like noise in the background, but like because since it's a strategic acquisition and you're looking to like acquire the business and like continue working in that area, then like maybe you would look at things like the transferability of like licenses of like the existing work that they're doing. So you so you're like sure that you can continue like using whatever like business they already have in place. I think you would also like, since there will be like a transfer of like ownership and control and maybe like the existing promoters would exit, then like another thing that you could possibly look at is like if there would be like a requirement of like taking the consent of anyone in any existing agreements, for example the lenders or like other parties that they have like a key existing agreements, etc.
Right. So I'll answer your points in a bitwise. So let's take an example. First, you pointed about the consents and all that, right? So let's understand from a strategic acquisition point of view. It's an acquisition of shares. Practically, I'm just buying the entity, and you would appreciate that all the licenses or the consents from either from a healthcare point of view or from any sector point of view is being awarded to an entity, right? Unless and until it's something which they would have a bearing about the name of the promoter or probably the some kind of a main person in that entity, that I can understand. But practically everything would be in that particular in the name of the company. Now the second comes in from making an exit by promoters. Definitely there could be a repercussions from a point of view that, like you pointed out, about lenders. Definitely, because in every lender contract, if I have to talk about the common law agreement or probably any kind of a security I provided, there is a standard covenant which has been provided of that any change in shareholding or change in board composition would require the prior written consent of the lender or lenders, right? So definitely, before executing the document, I would say that that particular document is must required, right? And there could be other documents also. There could be any licenses also, right? So let's take an example. If my property, right, that particular hospital is built on a leasehold land, right, and I'm planning to sell it off that particular land along as part of my company, it could be that one of the in the bylaws of the that particular land, it could have been written that any kind of a transfer of ownership or probably the right to use of that land through a lease also would require a prior written consent of that particular authority. It could be, right? So we would have to ensure that, and like what Narayan pointed out, that makes a lot of difference when you do it through due diligence, because the purpose of due diligence is itself to find out all these things, because that gives the comfort to your client, whoever you are representing, and practically it would be a buyer who would ask you to do this kind of a job, right? To ensure that, first of all, you have to understand from a acquisition point of view that what you're dealing with, right? In which sector you're dealing with, right? You can't just, if you have done a work or probably an acquisition in particular sector, it's not necessary that that would apply in other sector also, right? Specifically from a regulatory point of view, my point is, because in every regulatory point of view, there's always some kind of a loop which could have a material adverse effect on the transaction, right? So we have to understand, first of all, the entire rules and regulations or probably the statutory law around that particular sector in order to be 100% sure that if I'm getting on this particular transaction for my client, which is a buyer, I would have to ensure that these are the checks or the to-do which has to be done either before the execution of the documents or as a condition precedent to the transaction before the wiring of the money, right?
Yeah, and the basic example, guys, just to elaborate on Abhishek's point is, for instance, if you are, let's say, on the target company is your real estate entity, for instance, right, like Lodha or any of these entities, okay. And if you are doing diligence of Lodha, obviously real estate documents like becomes more important for you to diligence properly, right? And on the same hand, if you are doing diligence on Ola, for instance, right, then real estate document doesn't make really a lot of difference. You just need to have a proper checks, because Ola may not have many offices to begin with. Okay, so you need to be very mindful which company you are looking at, what business they are involved in, before initiating your diligence and before taking an approach towards a diligence, right? If it's a banking company, okay, let's say, right, like my company, for instance, Indiabus, right? If there's some action happening on this front, what should be the most crucial thing is to look at the loan documents, right? At the security documents, underlying security documentation. That becomes the most crucial thing to look at. Okay, to look at RBI laws in terms of any change of any control, what requirements, compliances you're required to make with RBI or NHB, primarily RBI, because NHB is subsumed under RBI now. So that is where your understanding should not be constant across sectors. It has to change basis which sector you are going to advise in future, right? Yes, Abhishek.
Yeah. So now we are clear on from an there is it's a strategic acquisition, right? First thing, what all things we have to keep in mind at first instance when we are about to start working on this documentation, right? Now there are other things we need to see. So first document, if I have to talk about, which comes out in front of you, that your boss asks you that, hey, we have received a term sheet from the buyer and they really want us, they have drafted some kind of a broad terms and we have to formulate a term sheet, right? So they ask you that, let's draft something for the buyer which is in the best interest of them, taking into account that it's a 100% acquisition and that to a strategic acquisition. So from your point of view, what all things would be the major concern? What would be the you have a basic understanding of that. You got a commercial that X is acquiring Y. This is the jurisdiction, blah blah blah. This is the consideration amount. What all things would come into your mind while drafting the document, or that small document, in terms of that, yes, I think these are the A, B, C, D, E, F. These are the must point which I need to capture it off while working on or probably drafting or reviewing of that document, right? So I think I'll put it on the floor if someone can.
Tamanna, I would like you to take this up.
So I think you would also want to look at the liabilities that the company is holding, if there is any outstanding debts or dues that the company has, and
Yeah.
whether they have disclosed it to the party.
Okay. Okay, but so I take your point, Tamanna, but any acquisition transaction, there is a legal due diligence and there is a financial due diligence, right? And practically, I understand that if they have not disclosed in their financials, or there could be any contingent liability, or there could be some kind of a silent liability, which eventually, if it comes out, it could result in a major losses for a buyer, right? But if I have to think it from a term sheet point of view, how would you think it that this is particular thing you need to capture it off in a term sheet? That you can't just put it off that, hey, if any contingent liability comes in, that becomes your liability.
Yes,
Right.
Neha.
Maybe what we should look at is if there are any pending cases on that particular company, if they're liable to pay something, any fraudulent cases or any such thing, maybe that also we should look at.
Okay.
Profit and loss statements also,
Okay. So
maybe.
guys, we are looking at not from a due diligence point of view. We are looking from a term sheet point of view. I think the main document is not getting, I think there's some
So
disalignment on
term
that.
term sheet is, guys, basically the very initial document. वहाँ पे आपने diligence नहीं start किया अभी. Okay.
Right.
तो आप लोग के जो points आ रहे हैं वो primarily diligence के आ रहे हैं. Term sheet हो गया, मैं और अभिषेक discussions में हैं कि अभिषेक, why don't let's merge on certain things, and Abhishek,
Right.
okay, what are commercials, and all those things will start. That is the sort of discussion we are having. So what
Right.
would that term sheet would entail? Diligence तो उसके बाद होगा ना, start, right?
So yeah, Anubha.
So here I want to try. So first, the charter documents, if they have MOA and AOA, we would
Okay.
first see what are the parties to the acquisition happening over here, and
Okay.
see who all are involved. So that and authorized capital, how much we are we will be raising in the due course.
Okay. But why would we would be concerned on authorized share capital?
So because it's a acquisition happening, so maybe since it's a strategic, so in due course also might be the authorized share capital be increased.
What
Okay.
if he's purchasing shares from me directly? There is no
Right.
issuance by the company, Anubha.
Right.
So there is no change in authorized share capital. Already जो मेरे पास shares हैं वही खरीद रहा है अभिषेक, right?
Yes, sir.
So that can also deal into acquisition now.
Yeah.
Yes, sir.
Yeah, Aishwarya.
Sir, I'm not very sure, but I think terms and so the term sheet would primarily be consist of all the terms and condition which would be there in the contract, although they won't be binding, but it would be a part of contract only, wherein terms and condition of both the parties would be, they would be putting it out on the paper.
Right. But if I have to think, let's go a bit more. So what all things you can think about which we can capture it in a term sheet from your point of view? Think it from a lawyer point of view plus from a client side also.
Think very logically, guys. You don't think कि मेरे को आता नहीं है, जाता नहीं है. ऐसे ही आएगा. तो think very logically. Try and give more logical perspective to terms what may be there from your client side. Vibhasa, you want
Representation
to?
and warranties.
Yeah.
Okay.
Probably indemnity. I'm not very sure because diligence is not being done yet.
Okay. Another thing.
Damages.
Okay. But would you think that so you pointed out at first instance that it's a non-binding document, and on the other side we are seeking indemnities and losses under that document. Can these two things be aligned?
No, sir.
Okay. So
anyone wants to? I think Abhishek, first of
yeah,
all,
I think
I think the guys who are from Master Workshop, आप लोग का किसी का हाथ इतनी देर में उठ रहा है, I'm really shocked. You guys know what term sheet is. You know what non-binding, what MOU is, what is not binding, what are binding clauses of a term sheet. ये सब पढ़ा हुआ है आप लोग का, right? Obviously, new guys who are from new workshop, they are excused. But
let's have Chavi on this. Chavi?
So I believe while drafting the term sheet, it's also important to understand the structure of the deal. What are the expectations of the client? Let's suppose one of the term sheets that we did for the logistics company.
Okay.
So they wanted to, it was basically a strategic acquisition only. So they wanted to have both primary investment and secondary investment. Primary is basically fresh issuance, and secondary is purchase of the existing shares. So if there's any obligation on the company, in terms of any working capital loan or any other credit facility that they've already taken, whether they want the acquirer to, set off those loans during the transaction. So understanding the primary construct of the transaction becomes very crucial.
Okay. So from the one we are discussing about, Chavi, that if we have to draw a 100% acquisition and we have to draw a term sheet for that, and specifically a strategic acquisition, what all things or the terms we would capture in a term sheet from your point of view? Shavi?
Since it's a 100% transaction, so apparently this would be by way of primary investment.
Okay.
So proposed transaction is one of the clauses that has to be looked into.
Okay.
Um, and since it's a primary transaction, so we would be interested in taking the equity from the company, right?
Okay.
As Aishwarya rightly pointed out, reps and warranties,
Okay.
indemnity, uh, all of which would be elaborated in the definitive documents.
But
This is-
why primary, Chavi? Why only primary?
so because it's a 100% transaction, right? So
But it's an acquisition.
yeah.
It's not a subscription document. It's not an
Oh, I'm sorry. I wanted to say secondary. Existing shares are being bought out, right? So
right.
so I wrongly mentioned primary in the first place.
Okay. So according to you, there is a secondary, and then so guys, let's take it like I'll give a brief about what all things we can capture it all. So if I have to acquire an entity, right? First of all, we would have to understand who all are the parties in terms of who would be party to the contract in terms of term sheet. First thing, which even Narayan pointed out, and like other people also pointed out, that it's a non-binding document, right? But there are certain provisions which we have to have them binding, right? One of the like the biggest thing for me, if I am a buyer, is the exclusivity or probably the confidentiality. These are the things I would really tend to put out to be like 100% binding, because if I don't tend to put out this kind of a provision to be binding, he can just take that particular term sheet to X number of guys and tend to bargain that, right? So we have to be 100% sure. So if you tend to see any kind of a term sheet document, you would see a paragraph at the top, right? And that document, that particular paragraph talks about that this term sheet is been dated, this has been entered into between parties, and it's a non-binding document except for the following provisions, which are binding on the parties. Now, there's a second angle to that. What all provisions, according to you, would be binding, right? According to me, it will be confidentiality. It could be if I have given any kind of a consideration, right? I would want that provision to be binding on that. If there is a break of a fee for any kind of a breach of any particular provision, that would be binding for me. It would be the governing law and jurisdiction provision to be binding on that. Another would be, as a buyer, I would also tend to put on an expense provision also to be binding. The reason for that is because I am putting out a lot of money on this transaction. And if this transaction goes off due to some act or omission of the seller, I really don't want to empty my pockets by spending on the bills for the lawyers or probably the CA firms, because parallelly the due diligence process has been carried out. There are a lot of people who are working day in, day out on this particular transaction, and there's a cost involved for that. So as a buyer, I need to be 100% sure that if I am working on a transaction and if it goes off due to any reason, my expense should not get hit off. It could be in an event also wherein I am doing a FDD or LDD, and there could be a adverse finding in the DD that I may not be able to proceed forward, right? So in that case, why I should take a burden of that? Because practically every deal, practically from a, if it's an issuance or probably it's an acquisition or anything, it practically works from how the due diligence has worked out, how the terms and conditions in the definitive documents have worked out, right? So we have to be 100% sure of how the due diligence and what we have defined specifically from a term sheet point of view. If I have to start with the basic underlining what all things has to be captured off about the party's name. Second thing, we have to be 100% sure, and we have to have something in form of a final, and we have to put it out to the client. okay, boss, if we are acquiring the entity, right, though it's a part of a due diligence to understand that who own the shares of that entity, right, in order to verify it. But we have to be 100% sure from a legal standpoint of view that A, B, C, D, if there are four shareholders, they are the only shareholders of that particular entity. If there is a sale of shares of that particular entity, the purpose is because this document will be signed by all the four people, right? Because they are practically agreeing into certain terms and conditions in order to sell their assets to the buyer, right? So in order to have that part, we need to be 100% sure that who all are the owner of the shares of that particular, all the shares of that company, right? Second comes in the company, because we have to have that company to be a party in order to ensure that, because there are certain corporate actions which has to be complied of, and in order to ensure that company complies of, if there are any terms which are defined in the term sheet which may be binding on the company, right? So we have to be 100% sure in order to have the company also to be a party. So who all are the party to the term sheet? There would be three. One would be the buyer. It could be one entity, it could be one individual, it could be multiple entities or individuals. Second is sellers. It could be individuals, it could be entities, it could be mix of. And the third is the company. That's the broad contours in terms of who all would be the parties to a term sheet, right? Now, another second point, which comes out to be consideration, right? Now we have to understand this is one of the biggest thing for a seller or for a buyer, because it's all about money, right? Let's be very practical. And everyone would be very categorical that everything is clearly defined if we are talking about consideration. Now, what all things you can consider from a consideration point of view, right? So we have to think it from that point of view, that how the movement of consideration is being carried out, right? So let's take an example. If it's a pure cash consideration, right, that particular amount, in what proportion it will get divided up or it will be paid on to a particular bank account of the sellers, that has to be clearly specified of, right? Second is, if I am talking about from a seller's point, or sorry, from a buyer's point of view, I need to be 100% sure from a tax point of view. What all I need to deduct if I am wiring off that particular amount from my bank account to the seller's bank account. Does there any kind of a tax liability in terms of tax deduction at source? If yes, I need to be 100% sure in order to deduct that, so that I can make the necessary filings with the income tax authorities so as to be compliant with the income tax laws in India, right? From a consideration point of view, that is one of the biggest thing in a term sheet. And we discussed about the numbers. If it's a cash consideration, who will get what, how the tax treatment would have to be considered of. Now there's another leg which I really want to discuss, is about what is the payment term, right? Payment term could be from multiple sides. It could be a one shot, that if the sale consideration is, let's take an example, 100 rupees, and I pay the 100% in one shot, and my liability in terms of payment gets off from a buyer's point of view. Or it could be in a form of a deferred consideration. I really want to evaluate the business of the company. I really want to see that if there is any kind of a liability once I take over the business of the company, so as to be 100% sure that if there would be any kind of a liability, I can just deduct that from the pending consideration, and I can just transfer the remaining balance to the sellers, right? So if I have to talk about from a deferred consideration point of view, what would you think about that? What all laws will come into play, right? If I have to finalize that this is the deferred consideration concept which I need to build in this particular term sheet. Anubha?
So we have to look into FEMA regulations.
Okay. So what FEMA talks about all this? So
Sir,
first of all, tell me the law. So FEMA is a very broad term. So please tell me what is the particular name of that particular law which talks about the deferred consideration.
sir, I do not know, sir.
Okay. And what is the law around that? Like, what is the law in relation to deferred consideration?
Sir, I couldn't recall it.
Anyone else wants to get try? Yes, Pratyush?
No, so another implication that comes to my mind on deferred consideration is the stamp duty thing. That when it will be paid, on how much shall it be paid, and to whom it shall be borne. Like, since the consideration is being paid on stages, so I guess that will have an implication on the stamp duty part also.
Okay. Any other point? Rishi? Okay.
No, so nothing to add.
Chavi?
So I think NDI rules would be applicable here. We
Okay.
recently
And so what is the provision under NDI rules?
so I mean out of the in terms of the consideration, the NDI rule says that 25% of the consideration amount has to be paid upfront, and the remaining consideration would be paid by the buyer within the timeline of 18 months, is what I recall.
Oh, you said opposite. So 75% has to be
Yeah.
paid upfront.
Yeah.
And the 25% is the maximum amount which anyone can defer it off. So guys, the concept works in from a FEMA point of view. And what Chavi pointed about the law is NDI rules. We call it to be Foreign Exchange Management Non-Debt Instrument Rules 2019. Just to give you a glimpse about how the FEMA works. And in India, it started off from a TISPRO regulation 2000. That's Foreign Exchange Management Transfer or Issue of Security by Person Resident Outside India 2000, right? Eventually, that got repealed and that was replaced in 2017 of 7th of November by TISPRO 2017. Again, the terminology remains the same. It's the new act regulation which came into force under Foreign Exchange Management Act 1999. Eventually, on 19th of October 2019, a new law came into place, Foreign Exchange Management Non-Debt Instrument Rules 2019. Can anyone help me out to explain why there was a repeal and there was a new rules framed under FEMA? Why there was a sudden shift wherein the government has drafted, or probably I would say the RBI drafted this particular 2017 mark, and immediately after 2 years, they thought of just removing this regulations, and they thought of coming up with the new rules. Any guess, guys? Neha? Okay. So guys, I'll go back to 2015, wherein in one of the speech by finance minister, it was clearly pointed out. So I'll give you a brief, a bit of history around how the evolution or probably the FDI concept used to work in India. And probably you can then, probably you will get a better clarity in terms of Googling it out. So in initial part of, like, when it was a TISPRO regulation, either from a 2000 or 2017 point of view, the onus of coming out with this kind of a regulation was on RBI, right? And whatever they used to do it of, they used to do it in consultation with the central government of India, right? When you think about the 2015, if anyone would have an idea, there was a sudden shift and there was a certain um, declaration, I would say in a speech by finance minister, where they clearly pointed out that they really want to make an amendment to this particular concept of FDI, right? And because of which, in 2019, there was a switch in terms of who would be taking an onus of FDI, who would be having a control on any kind of rules, or like I would say the laws around FDI, right? You would see a major difference would be that if I see that TISPRO, it ends with regulations, 2017 or 2000. But when I talk about rules, it's practically the 2019 is a rules. It's not a regulation. It's not an act, right? And if I see the entire entire set of rules, regulation, everything under FEMA, it's been divided into two parts. Either it's a rules or it's a regulations. But initially the rules were very less. I think one or two only major I can recall about current account transactions and all that. But why? Why? What was the reason? The main reason was who controls that in law in India. It was the center government which used to control that in consultation with RBI. So who has a discretionary power in terms of making an amendment to that? It was Ministry of Finance under Government of India, who you can make any kind of a change at any point of time. Though from a provision point of view, they would have to take some kind of a consultation with an RBI in order to enforce any kind of a change under law. But the main control or probably the discretionary power remains with Ministry of Finance. That was a change which was brought in 2019, wherein the entire control passed on from RBI to central government under Ministry of Finance. So you would see, initially we used to have just regulations, either it's a 2000 or 2017. It used to talk about two things, one about the substantive process and another was the procedural concept. What all forms we need to file it off. It was FCGPR, FCTR, whatever it was. So everything was defined under one regulation. But once there was a shift in 2019, there were two separate legislations, I would say. One was a rule because the substantive part under FDI moved out from Reserve Bank of India to Ministry of Finance under Government of India. But the procedural part remained with Reserve Bank of India, right? So if you have to see it at this point of time, the what all forms you have to file it off practically is the same form, FCGPR, FCTR, as though from the process point of view, SMF and all that has came into place. The construct remains the same in all forms, right? But the power has gone off, right? Now coming up to the law, which we were talking about from a consideration point of view, is the deferred consideration concept. The law has evolved a bit long on this. I think it was way back, I think 2015, 16 or something, wherein I don't recall that particular year when this particular provision came into force under TISPRO Regulation 2000, wherein the law was clear of that if there is any cross-border acquisition going on, wherein a foreign entity is acquiring the Indian entity, and they tend to put out any kind of a deferred consideration concept, either in terms of deferring the consideration or putting out that money in escrow or taking an indemnity against the deferred concept, that particular liability of deferred consideration, deferred in terms of escrow or in terms of indemnity, would be not more than 25%. So that is one of the things we have to be 100% sure of how we are considering. So that's another thing when we are working on a term sheet, we have to be 100% sure when we are advising a client. So let's take an example. Client says that 100% I am a foreign investor. I really don't want to give 100%, right? And we just want that I need that particular consideration. We'll take 40% as a deferred one, 60 as a one-shot payment upfront on the signing of the deal. And we just want to play that, and we really want to keep that money for 4 years and all that. That is not practically how it works, right? So like we discussed about consideration, so that amount we would have to advise to our client that, boss, you cannot consider 40% as consideration. You cannot keep it for 4 years, right? It has to be for a specific period, which is defined under law. And it has to be 25% max, which you can consider of. You cannot go beyond, because that is clearly a contravention concept in terms of contravention of the provisions of FEMA, right? So that is something which we would have to advise to our clients in terms of putting out that. Now, there could be a concept in terms of, so I'll go further. So Anubha, I'll take your point. So what you raised your hand, so I thought I'll just ask you.
Yes, sir. So I have a doubt. So in case of deferred consideration, what if at the time of due diligence, there are certain encumbrances which are crucial, and at that point, buyer wants to sort of back off from the entire transaction? Will this 75% be taken back by the buyer, or will that be reflected on the expenses clause of the term sheet?
So think it from that point of view, that when you are doing a due diligence, Anubha, you are not practically transferring any consideration at that point of time, right? It is part of the process, but this process, the due diligence process, has to be completed before execution of the definitive documents, right? Because till the time that buyer gets to know that what all things, what all issues are there in the company, they will not be in a position to go back to their board or probably have their final approval in terms of signing of the documents, right? Now, going to your point that if there is any bigger issue which has come into play, and the investor is either they would want to find out some kind of a solution, so they can ask you that, boss, help me to find out some kind of a solution wherein I can protect myself if we build some kind of a provision in our contracts which can help us in terms of protecting our interests, right? So help us. But if from a legal standpoint of view, and how you would appreciate that how India law is being evolving day by day, so how, and it is becoming stricter day by day. From that point of view, if you are not able to comment on that particular, that there are very limited possibilities in terms of protecting through law point of view or from a contractual point of view, they might consider dropping of the deal, right? The max loss they could consider at that point of time is the loss in terms of time and money, right? Because they would have spent a lot of time in this particular transaction. Plus, from a money point of view, because a lot of chartered accountant, lawyers, company secretaries would be working on day in, day out in order to find out what are the loopholes, what are the issues at the drafting of the documents, the discussion between the lawyers, because that kind of a thing goes hand on hand in terms of due diligence and the definitive documents. So from that point of view, any buyer would want that from a term sheet point of view, and which I really pointed out like my 10-15 minutes back, that certain provisions have to be binding under term sheet in order to have them enforceable provisions under the term sheet, right? And one of which is the expense provision, right? At first instance, if I am a buyer side, I'm a lawyer representing buyer side, I really don't want to put out any kind of a caveat in terms of when a seller is under an obligation to pay me or not, right? I would put it out as a blanket statement that this is the liability of the seller in terms of all the costs, whether it's a financial due diligence, legal due diligence, any kind of a work which has to be carried out, even if it's a 50 lakh or whatever that is, right? So by this mechanism, one can practically enforce that, right? In terms of getting of their money, and you would have to see that practically money doesn't go to them, right? So even from a more practical point of view, so let's take an example. My law firm is working on this particular transaction for and on behalf of a buyer, right? And we think that they hired us for the drafting plus legal due diligence. So we won't be raising out that engagement letter or probably an invoice to the buyer. We will be directly working out or probably drawing off an engagement letter directly with the company, wherein we will categorically put out that our client is the buyer and we are representing here for and on behalf of our buyer. But we will bill you because it is your responsibility in terms of paying of the fees. and wherein they sign it off in order to agree onto that particular contract. And as and when that particular mandate gets closed off, either at a pre-execution stage or post-execution stage or probably post-closing stage, whatever that stage has been agreed on, we as a lawyers would have to directly bill it to the selling entity in order to get our money, right? So that from a liability point of view, buyer doesn't get any kind of an invoices or any kind of a commitment directly. So they always believe that it should be directly with the company whose responsibility is to pay that money. I
Understood,
hope
sir.
I'm able to answer your query.
Yes, sir.
So another point goes is, I think another point is, uh, from a consideration point of view, one way is I say that, boss, I really put out 24% and I'll disperse that amount. I really want to run the industry, that particular business. If I am able to find out that there are no issues for a particular frame, I'll just transfer the money and I close that particular transaction, right? Then my liability goes off. There could be another things also in that, right? And specifically, which I've seen from an M&A point of view, they would want to run the business and it's linked to the revenues, the profits, EBITDA, what it could be multiple things, right? And that numbers or probably the formulas would make a major role in play. Why? So what they would do is there would be an adjustment concept in that consideration. So let's take an example. If I am disclosing, so what happens? Sellers put out that my revenue is this, my EBITDA is this, X, Y, Z, all the information, financial information. But when I'm running the company, or probably I'm doing a due diligence, the numbers are different, right? And specifically, there has to be, and when I started off with the company in terms of acquiring that company, I thought I saw the things to be different, but eventually there's another financial year, or probably the 1 year has been spent off and the numbers are completely different, right? So I would want some kind of an adjustment in terms of what consideration I paid in to the seller. So that's a broad contour. I won't get into much on detail in terms of how the formula would come into. But if I have to think about that, if anything which is hitting that particular formula in terms of decreasing the consideration, that particular consideration, that decrease would not be the liability of the buyer, right? And that particular amount will not form part of the consideration, that will get automatically deducted from the consideration. Now, the concern comes in from a cross-border point of view, that what maximum amount I can consider from a deferred point of view or from an adjustment point of view, that is max to 25%, right? So this is one of the, I would say from a foreign investor point of view, this is one of the flaw under Indian law, wherein there is a capping in terms of the deferred, but it's good for the Indian resident because somehow it has been a practical uh, uh, insight in from a cross-border acquisition point of view, wherein the foreign investors have tend to put out a lot of money in the under deferred consideration. Now they cannot do it because it's a law under under Indian law, right? Now I take a more step in terms of next step, like
You want to take
how.
a break of 5 minutes, Abhishek?
Sure.
Yeah. So I think we can reconvene in like 5 minutes, guys. So that
Okay,
Abhishek can also, because I think he spoke for straight 1 hour.
no
So
problem.
just we can take for 5 minutes.
Sure.
Join back, guys. Vibhasa, please put out on the group.
Yes.
And a new workshop batch was there. Deepak, can you please put it on the other group? So guys, till the time Abhishek joins, so whatever we are discussing till now, right, in terms of mergers, amalgamations, acquisitions, takeovers, don't get uh, too sort of, I think this is not the time where to dive too much into it. Okay, try and understand it at a very basic level. Okay, Abhishek is sharing all his experience, so please take notes of it. This is not something you will get otherwise in college, or maybe even in your internship. You will never understand the nuances. So better take note of it, so that these things is something which even I am not aware of, to be honest, right? So these are all important learnings. But while learning, don't get too much harrowed by the fact कि मेरे को नहीं आता या मेरे को बहुत ज्यादा लग रहा है. ये सब चीजें धीरे धीरे समझ में आ जाएंगी आगे. ठीक है? So just try and understand it very basic level for yourself and take notes of whatever we are discussing here. Okay? Right? So Abhishek is here. Guys, we can start. Please switch on a video. Yeah, this is not something we have to tell you again and again. Neha,
So-
Bhumika, Pallavi, Ryan, Shilpi, Ananya, switch on the videos. Yes, Abhishek, we can start.
Sure. So I think, like Narayan pointed out, that I think it really went into deep in terms of term sheet and all the definitive documents, and that's definitely one of the sessions which we have planned off in the month of October. So I think I'll take a step back in terms of giving a brief about how the acquisition works in and what all basic concepts of acquisition and and everything around that. So one of the thing which we really talk about, uh, so let's take an example. There are two bike companies, manufacturing companies of motorcycle. One is Bajaj and another is TVS, I would say. And they really both, one entity acquires the another entity, what we will call it to be. Or they tend to form out a merger in terms of amalgamation, right? What we would call it to be.
Horizontal merger.
Okay, yeah. So ideally, it's more of from a concept when two companies which are working in the same line of business and one entity acquires the another entity, or they form some kind of a new entity wherein they amalgamate each other in the form of a new entity, that we call it to be more like a horizontal acquisition or amalgamation, whatever term we tend to put out, right? Then there's a vertical, right? How would you quantify or probably qualify what do you mean by vertical amalgamation or acquisition? Yeah, anyone? Vanshika.
As per my understanding, in a vertical acquisition or a merger, the companies in different stages of production, maybe a manufacturing company is acquiring a company that produces raw material or supplies a raw material. In that chain, if there is a merger, there'll be a vertical.
Yeah. So, going with one of the example we recently found out about is, so for the horizontal, like we recently had an acquisition in terms of merger of Vodafone with Idea, right? That's a clear-cut example internally we can see in our day-to-day life. From a vertical point of view, everyone knows about Zomato, right? So they practically acquired their on-demand logistics startup Runner. So that's one of the vertical acquisitions, I would say, from an acquisition point of view. Now there is another concept also, reverse merger, right? Any idea about that? Anyone? Anushka? Sharma?
So basically, the subsidiary company goes back into the parent company. That's a reverse merger. The recent example could be the HDFC Bank and the IDFC Bank merger. The HDFC merger and the IDFC merger.
Okay. And any other? So I go with, but any other, like what all events we can consider from a reverse merger?
Vibhas,
Yes, sir. So it's basically when a public company, a public company acquires control of a private company, and the private company becomes the holding company, right?
Yeah, actually, you turned around the concept. So it's actually a private company which acquires the public list.
Right.
Yeah.
Yes, Rishi, would like to explain it in a more clear manner? Right.
Yes, sir. So when a private company acquires control of a public company or a listed company, and through that transaction, it is getting listed on the stock exchange. So it is going about getting listed in the opposite direction as compared to an IPO.
Okay. Any example, any day-to-day example, if you would heard about like in newspapers or anything?
Sorry, sir, can't recall.
Anyone else? Yeah, Sarvesh. Sorry, your voice was not.
Your voice is loud, Sarvesh.
Am I audible now?
Yeah, better.
Okay, so Nirma is going to acquire the Glenmark Life Sciences. So Nirma is an unlisted company, and they're going to acquire the Glenmark Life Sciences from Glenmark Group. So that's a sort of a reverse merger.
Okay. I don't have much of idea about that.
Even I don't have, but a good example. I think that's right, Sarvesh. So even I'm taking note of it. Yeah. So this is something, and please take note, guys. If I'm taking, even you guys can, because all of this is something we're going to read in next 1 month. Okay, all of these, even Vodafone Idea, for instance, Abhishek mentioned right in the beginning, which is a horizontal merger example. You should have taken note of it because you should read about the scheme involving Vodafone Idea merger, right? What is the rationale, what is the reasoning, and why it happened? And we all know that it was more from the perspective of competition, which they were going to face with Jio and Airtel and others, and to have a better reach in the market, right? So this is something which you have to take note. These are case studies which you're going to do. So this one is, you're saying reverse merger, Nirma Life Sciences, right, Sabesh?
So Nirma is taking the control on Glenmark Life Sciences.
Okay. Okay. Anyone else? Anything?
I think another example which I understand and I have a brief understanding about the ICICI, right? So practically ICICI Bank now owns the entire, in terms of all the businesses and everything from within the ICICI group. So that is something which is, to my knowledge, falls within reverse merger. Going forward is another within stream merger. Any idea about within stream merger? or probably acquisition or whatever we call it to be.
Anyone?
Harsh?
Sir, I'm not able.
Okay. So ideally, it talks about wherein we, like a parent company, which is like running a couple of subsidiaries company, right? They tend to merge all these entities into one entity from an operational efficiency point of view or from a utilization of resources point of view. So there are two concepts which we tend to put out. Basically, the majorly is from an operational efficiency, and the second is the utilization of resources, wherein any group which has a lot of subsidiaries, they tend to merge it all into one entity in order to have a better utilization of resources and all that. So that falls within the bracket of within stream merger, right? So let's take an example of ITC Group. They decided to merge their three wholly owned subsidiaries, Sunrise Food, Hobbit International, and Sunrise Sheetgraha within itself. So that is one thing which but I could recall an example of. Another type of acquisition or merger, I would say it to be market expansion, right? From a market expansion point of view, when there are two companies which are selling off a product in two different markets, right? So let's suppose one company, let's suppose A is selling out a product, they are operating in X jurisdiction, and there's another company called B, which is operating in a Y jurisdiction. They merge in order to expand the horizons of the both entities, right? Another could be a product expansion
So this
merger.
market expansion is something which can fall under horizontal merger category also, right?
Right.
Yeah. So it can be, because we're talking about two entities working in same industry but in different geographies.
Right.
And then they're merging to basically cater to larger market.
Right.
Yeah.
Another form's product expansion merger. It could be in a form of a vertical side, wherein I am expanding. I am having a vertical merger with, like, practically there are two companies working on two different products, but in the same market. So they form a merger in order to expand the horizon of the products they're selling it off, right? So that's one of the things which like we thought about coming up with a concept. Now the another concept which I really want to discuss about the acquisition, and then we started off with that, is how you would differentiate what is an acquisition, what kind of acquisition going on. Primarily, we discussed about the financial aspect and the strategic aspect, but within that, there are majorly three concepts which we tend to play it off. Is a minority stake, majority stake, and a full majority stake, like a full stake or a complete control of the company. I would say a full stake in the company. That would be appropriate word. So minority stake could be anything. It could be 10%, 15%, 20%, 25%. Normally, it's more than 25% because there is a reason for that, acquiring more than 25%. Anyone, any guesses around why?
Please, and I'd expect more hands this time for this question. Ryan, please.
Yeah, Vanshika.
No, Ryan Joseph is someone who has become inactive of late. Ryan?
Sir, I'm connected on hotspot, so the voice is glitching a little bit.
No, we can hear you completely, like you're completely audible.
No, I heard that 25% transaction, but I was not able to hear the full question.
So I'll repeat for you, yeah. So we're discussing about the minority stake. Why generally, so it could be 10%, it could be 20%. Why we consider, why a buyer would want a minimum stake of more than 25% in a company? Why they would consider that? What is
25 number which is good for a buyer?
Because if you hold more than 25, you have enough control to stop special resolutions, which gives you more control on prohibiting any material change to the articles or any important features of the company.
And it is important for new workshop students who are learning company law to understand how all this works now, how that company law concepts which you're learning becomes applicable at a major level in bigger transactions, right? You guys are learning about special resolution, shareholder resolution, and all stuff. Now there, how this 25%, right? How that 3/4 majority resolution we talk about, right? 25% or more can block that, and that sort of give you a right as a minority shareholder to block all those special resolutions, right? Clear hai, Tamanna? Yeah. Yes, please, Abhishek.
Sure. But guys, have you ever thought about that if a client comes to you, right? And I'm being very little, I'm just going out of the scope, but I really want to take that touch with, and in terms of how you think around. There's a client which comes to you that, guys, I really don't want to spend a lot of money. I don't want to take more than 25%. I just want 15%, 20%. But I really want some kind of a control over the company in terms of matters, how they have been put up. Like he pointed about the special resolution. Can our 20% guy who is holding like 20% in the company, can he take a control? And control, I would say, in terms of certain matters, he's very finicky about that this kind of matters should not pass it off without my consent, right? So he doesn't, because practically what I would term it to be that if it's from a shareholder's point of view, it is the ordinary or special. Ordinary requires minimum 51%, special requires more than 75%. So how he being a 20% guy can take a control of
And
that?
yeah, for students who are from master workshop, they know that. But for new students, simple question is, even with lesser stake, even with stake less than 25%, even with, let's say, 15% stake, 20%, I think Abhishek mentioned, but even let's say with 15% stake,
Right.
can you be in the driving seat? Can you be the one who is going to take, who has some sort of control, or control, not control from takeover perspective, I'm not, but who has some sort of power within the company? So this is something I would expect. Who? Anubhav, please.
So, sir, basically, if we look at the shareholders agreement, then there can be certain restrictive rights that the shareholders can impose upon. For example, if they are only holding 15%, but say they have a restrictive right that the amendments to the charter documents cannot happen without the consent of without our consent. So, in those ways, they can try and take control through those restrictive covenants.
Okay. And we call it to be like any particular term, that particular right to be, what we call it of, guys?
Yes, Vibhasa. V for Vibhasa and V for.
Yes.
Confused
So
again.
veto rights. No, sir, it's veto rights. And we put it under reserve matters clause.
Right. And another terminology is affirmative voting matters. So there's a two
Affirmative
terminology.
rights, right.
Yeah, we tend to call it off. So yeah, that's the concept. We call it from a minority point of view that we discussed about. Majority is wherein people are requiring, I would say, more than 50%, because they would want some kind of a control on the company. They would want a majority on the board, in majority in terms of from an ordinary resolution point of view. So they would want that kind of a concept to be as a part of the company. I'll give you a very small example on this, and I thought that popped up in my mind, and that would be really helpful for you guys. So we were working on a transaction, right? And the acquisition was 100%, but it was in two phases. So one was a majority, so they were acquiring 60%, and subsequently they're going to be acquiring 40%. And that 40% acquisition was eventually within a period of 12 months, right? And what they thought of that I am acquiring, because that entity, the buyer was like a big shot entity in India, like they are one of the unicorns in India. And they thought of that I am acquiring 60%. But eventually, if I have to consider having any special resolutions to be passed off, right? Practically, I cannot pass it off, even if I have a reserve matter, right? Because how the reserve matter works is, it has to go through a normal process, but it requires my consent. But if I turn around the table, and if I have to pass out a matter, that would also require the consent of other party, because practically I have less than 75% in the company, right? Because of that, what we did of, and I'm sure people might or may not know about the understanding, so I'm just giving in a brief. We thought of subscribing to certain shares. The purpose of subscription to certain shares, and that shares were very minimal, that were like a normal equity, or I think the CCPS, and I hope guys know CCPS is the compulsory convertible preference shares. And we thought of acquiring a very small stake, like I think 2-3% or 4%, right? And that we created a different class in the company. But what we did of to get the 75% is we changed the conversion ratio of that instrument, or I would say the voting rights, the ratio of the voting rights we changed off. So we did 1:35. And because of that, my voting right raised up to 81%. So practically now no one can actually block my special resolution also if I tend to put out in the shareholders meeting, right? So that's how I thought, like, because we were discussing about majority, these are also some things which tend to come out in the mind of anyone, that how a reserve matter works, or probably I just get a reserve matter and I can play the shots. No, it doesn't work in that way also. There is one side of reserve matter that they cannot pass out a matter without my consent. But if I have to turn around the table in terms of if I have to pass out any matter before the shareholders, how does that would work? I would practically need a consent of them, right, in order to pass that matter. And there has to be some kind of mechanism in order to ensure that if he doesn't approve that matter and that matter requires and is of greater importance to me, I would need some kind of a veto right in terms of passing of that matter, right? And the last goes is a full stake, which we already discussed, is majorly from a strategic point of view, which I have seen in my practical experience. There are very few which have seen it from a financial point of view. One I could recall is one of the private equity players acquired the information technology arm of Indigo. So there is a company, I think Intel, so I don't recall the name of the company, but that was an IT arm of Indigo Group, basically Interglobe Group. So initially their name was Interglobe Technologies, right? And there was one of the major investors sitting on their cap table that was a private equity player, right? And eventually that private equity player acquired the entire stake in that company. And Indigo, or probably I would say Interglobe, moved out, right? And now this company is, the purpose was not strategic, because their entity doesn't have any role to play, because they are just a financial investors. They believe in buying and selling, right? So 100% majorly is from a strategic, but yes, there could be a financial interest also. Like, for example, renewable sector, there's a lot of interest. Infrastructure, there is a lot of interest by PVC players who are investing, or they are practically running the shows. One of which I could recall is the Sanvian. That's a wind energy project, a company in India that's been run by a foreign entity. But initially that was, I could recall that was some Indian division was part of some PVC arm, which subsequently got sold off to another strategic investor. So they made their money, they sold it off to another strategic investor, and that's how the structure worked out. So just a brief about how full majority works, right? Another comes in uh, uh, from a structuring point of view, how we do it. And I'll give you a very small brief about, we do a term sheet, we do a definitives, we do all this. And from a term sheet point of view also, we tend to put out a broad contours, like some pointed about a rep and warranties, right? Some pointed about certain other provisions. And like we discussed about certain provisions, like what are the parties' name, what kind of numbers are there, how the consideration will be paid, uh, what all restrictions has to be imposed on the sellers, on the companies, so as to ensure that there is no these sellers doesn't take any kind of a disadvantage of this particular transaction, and or probably how the broad probably if I have to, because practically till the complete acquisition goes off, the sellers would be running out the company, and they don't want, the buyer won't want that they do any act which could hamper the deal. So they would want certain actions, their actions to be restricted to particular actions only, which is parallelly in an ordinary course of business only, not beyond that, right? So they would want certain kind of things to be put on the company and probably on uh, the buyers and sellers, right? Then comes about the CPs, the condition precedents, what all things you find it out initially, broad contours, very broad contours. You would want to do a due diligence. There has to be some findings and all that. All the requisite approvals are there. All the I could say there is no litigation, all broad contours. If there is a static acquisition or something is one of the main essence of that acquisition, that will be form parting of CP or probably as a part of the main covenants under that particular transaction. So it could be a mixture of that kind of a provisions will be captured in the term sheet, right? So that is another thing which we tend to put out. And lastly, we discussed about how the boilerplates or probably the miscellaneous provisions comes out to be, it could be share cost, taxes, stamp duty payments and all that, because ideally we should have the stamp duty executed on the stamp paper and all that, but that's another ball game. Now we are talking about why. So I'll give you an example that why we really want to, and that to be very concise, that what is the purpose of doing an M&A, probably an acquisition or anything. There is always a logic to that, right? And specifically from a buyer's point of view, how they want to, and we discussed about a lot of types practically, that there is an intent to that in terms of how they want to. Either it's an expansion mode in terms of entering into new product sector, like they want to expand their horizons in terms of their business. They really want to get into other sectors. So there could be a lot of things. And it could be a tax liability also. So let's suppose there is a company which is running into losses and losses, and the promoters of that company has shut off that company, right? But the losses are standing on the financial statements of the company. If anyone buys of that entity in pennies, they can take an advantage of that tax liability. So probably the losses on the balance sheet, right? And they can have discounted, like they can take that and they can decrease their tax liability, right? That could be one of the reasons. So from a M&A point of view, what practically is considered to be, right? Now, another form of acquisition, and we call it to be a joint venture. Practically, joint venture is not practically to be called to be acquiring the shares of the existing company. It's more of considered to be forming a new entity wherein the existing buyer or seller tends to acquire a stake in a new entity and they run the show, right? They together run the show. But that joint venture could be of different types, right? Everyone would have an idea about I don't recall, but I can give you a brief about Tata, right? They have a lot of joint ventures. They had a joint venture with, you would have heard about Tata Sky. Sky was I think British or like European company, and they had a JV with Starbucks, right? Tata Starbucks. How that would have been formed up, though I don't have a very practical insight about that transaction, but minimal which I can consider of is acquiring a stake, the forming of a new entity in India, right? And both entities acquiring a stake in that company, bringing out different strength which each entity would hold. For example, Tata being financially cash rich company, they would definitely bring out their financials, right? If I talk about Starbucks, they are bringing their royalties, the how the coffees are made of, their patents or whatever that could be. They basically, I would say the IP, which they would bring it out. Right? And that's how this brand has got expansion mode in from a jurisdiction point of view, right? Because in India, you won't see Starbucks like a 20 years back, right? Has been like 10 years, 15 years only that Starbucks has come into play and how they have made a market, right? So it depends on how a joint venture is being found out. But I'll come up with another example for you. Have you ever seen, I would say, anyone heard about unincorporated joint ventures? Anyone? So unincorporated joint venture. So yeah. So one guy, Ryan.
Yes, sir. So I think they are contractual
Your
Are
voice is
you?
breaking, Ryan.
instead of setting up a company and then registering it, you Is better? So am I
No,
audible?
it's
Yeah,
breaking.
kind
Yeah, no better. Yeah.
Yes, I'm sorry, I'm on my hotspot. There's
Yeah.
something wrong with the Wi-Fi. But what I was saying is that such JVs, instead of setting up a company and then registering it, parties mutually sign a contract, and all their the JV terms flow from that particular contract. And this is particularly beneficial from certain tax perspectives, and especially in scenarios where the two parties don't want to stay in the joint venture for a very long period.
Okay. So what is the main advantage of that, Ryan?
Um, I think one commercial benefit is that if you are going to set up a so through a if you merely have a contractual JV, it gives you a better control over your intellectual property that you might have to share with the counterparty. Because if you're going to set up a company, then the intellectual property will most likely be licensed or transferred to that company. But through contractual JV, you can have better carve outs, and you have more autonomy on how much access needs to be given.
Okay. Any other thing?
Um, I think there are also fewer compliances because the relations are flowing from a contract, unlike a registered entity.
Okay.
Yeah. On the top of my head, I can think only
Yes,
of
Rishi.
these two.
So I think a contractual joint venture or an unincorporated joint venture would be easier to set up and to start than an incorporated one. It's easier to just enter into a contract and start work rather than setting up a new entity. It's also easier to exit. In dissolution and separation of assets at the time of ending the joint venture would be easier if it's a contract where you have a termination clause as compared to dissolution of an entity.
But what would you consider from a negative point of view? So you talked about a positive, right? So we have a like from a compliance point of view, it's minimal under unincorporated one. We have a protection of IP. What do you consider from a negative point of view from in an unincorporated in comparison to an incorporated one?
The parties are bound together in a stricter manner in an incorporated joint venture.
But that
The
would
same point where it's easier to exit can also be a disadvantage, that it can be easier to exit. And
but if I have to see it from that lens, if I'm forming an entity in India and it's called an incorporated joint venture, I'm also bound under that also. I can't shy away from my obligations because practically I would be entering into a joint venture agreement and that will be applicable and binding on me. So what is
right, but what my thinking is that would probably be less stringent and little easier to maneuver as compared to an incorporated entity.
okay?
And the benefit for an incorporated joint venture, I think, would be that it gets all the characteristics of a company. It has perpetual succession and all of that. And it would probably
have a more solid brand value, but that is more on the business side than the legal side.
Okay. But have you ever thought about a concept of ring fencing? Like,
Could you
did
repeat that,
anyone
sir?
heard about a concept of ring fencing? Right. So practically, I see the major difference in an incorporated and unincorporating is how we consider ring fencing, or we call it to be off balance sheet structure, right? What is the concept that is? So practically, let's suppose we are working on a JV and there's a huge liability which comes up, 1,000 crore of tax liability which comes on, where it would be sitting on in an incorporated or unincorporated one. Anubha. I think I said Anubha. She's there.
Yes, sir. I'm there, sir. Sir, could you please repeat the
So let's
question?
take an example. There is a joint venture, right? And you have both scenarios, incorporated and unincorporated. You get a tax liability of 1,000 crore rupees. What would be your take in terms of incorporated or unincorporated? Which would be better for you?
So I would say incorporated, unincorporated, because
Why?
so just like you said, it'd be easier for off balance sheet reflection.
No, but it's not a off balance sheet, no? Unincorporated one is not a off balance sheet. Or I'll use the word ring fencing. There is no ring fencing in an unincorporated one. So practically, there is a liability, right? And if I have to see it from a lens of an unincorporated one, which is through a contractual, ideally it will be reflecting on my balance sheet also as a principal
Abhishek,
entity.
I would request you to give background regarding
Sure.
unincorporated. I think these guys have not got the
Sure, sure.
understanding and how ring fencing is working in that.
Sure, sure. So practically, so guys, the understanding of incorporated and unincorporated is, incorporated one is wherein, let's suppose Narayan and I am, like, Narayan has his own entity, right? ABCD Private Limited, and I own another entity, XYZ Private Limited, right? We tend to form up, we thought like, let's start a joint venture, which we thought of starting up a new joint venture, right? And we thought that let's incorporate a new company and let's carry out the joint venture through that particular entity, right? Irrespective of what the stake in that company we hold, right? It could be 50-50, it could be 26-74, whatever that is, right? So we start that business, that particular new line of business, through that new incorporated joint venture. That's, we call it to be incorporated joint venture. The another scenario which comes out to be unincorporated joint venture is wherein we don't form any entity, right? What we'll do is we'll form a consortium agreement or an unincorporated JV agreement or whatever. That's only a piece of document. Will not form any entity. Nothing will be there. The two entities which would be running the show will be ABCD Private Limited and XYZ Private Limited, through a contract structure wherein we will be dividing, or I would say define our roles and responsibilities, what each party is bringing on table, right? How the liabilities will be taken into account. If there is any liability, whose responsibility would be to bear it off, XYZ. That document only talks about A, B, C, D, E, F, G, H. But it's not a standalone entity. It is only a contract which governs that. Now, giving of this scenario, let's understand that you form a contractual JV, we call it to be unincorporated JV, as ABCD XYZ unincorporated JV, or this is the name we form under consortium agreement or a JV agreement. And there is a tax notice which comes on this ABCD XYZ JV, right? And there is a tax liability which comes on the new JV entity which we have formed at the incorporated joint venture. So what is the difference now? The difference comes in from a ring fencing point of view. Let's go back to our basics of the Companies Act, right? Because here the basics, what we call it to be private limited company, limited by shares, right? What is the main essence of a Companies Act or a Limited Liability Partnership Act? The main essence is the liability being limited, right? That's the main essence comes in. In an incorporated joint venture, when we are forming, we are pulling of our resources to form a new entity and run the show, the liability will be restricted to that particular entity. Unless and until there's a big fraud, there's a lifting of a corporate wheel under Companies Act, then it may pass it on to the shareholders. But that is very exceptional. Otherwise, it will limit. So we call it to be a ring fencing structure, right? Wherein we fence the liability in order to ensure that that liability doesn't passes on to the shareholders, to the main entities who are clubbing form to form this joint venture. But when we form it over the unincorporated joint venture, there is no ring fencing. It's just a contract, right? There is no legal entity. So practically, the basic principles of Companies Act won't apply in that case, because Companies Act doesn't govern that particular contract or the unincorporated JV agreement. Companies Act only covers the company. So ideally, what Companies Act would do, it would cover ABCD Private Limited and XYZ Limited, not that ABCD XYZ JV, because they would so भैया ये तो पेपर है, मैं इसके नाम पे नोटिस भेज दूंगा, मगर liability will be of the JV partners under that document, which is ABCD Private Limited and XYZ Private Limited. There is no ring fencing because there is no, under law, you have not created a structure wherein the liability can stop to that particular JV only. It doesn't passes on to the shareholders of the company, of that particular JV, right? There are advantages and there are disadvantages, right? Like Ran pointed about a protection of IP. We can do that, right? In an unincorporated JV, that is, we can consider in terms of defining of what is an IP, though that can be also done in another JV also. But that could be one of the reasons. One of the major things why people tend to do unincorporated JV is tax losses or any kind of a losses wherein they can take a benefit under their principal entities. So let's suppose the unincorporated JV faces of 1,000 crore loss. They can book that in their books of accounts of the principal entities and take a benefit in terms of from a tax point of view. That's why we don't call it to be an off-balance sheet structure. Reason, because we cannot hide, or probably we cannot seclude the losses which are there in a JV under the principal entities. It will come into the balance sheet of the principal entities. But when we talk about incorporated JV, it will not come. It may reflect, it depends on if it is a subsidiary. From a consolidation point of view, it might reflect, but it will not have a repercussion in terms of liability coming up at the parent level. That liability will remain at a subsidiary or probably at the joint venture level only, so as to ensure that it doesn't passes on to the shareholders of that joint venture. I hope that the understanding and layman had worked out for you guys.
Yes, I think that's a very detailed explanation, guys. Any question? So I think with that, Abhishek, we should. Or is anything else to be discussed today?
No, I think so. That was.
So any questions, guys? Anything which you want to ask Abhishek and me, or maybe? Yes, Ryan.
Sir, I just wanted to add that one another benefit of having a incorporated JV is that if you have a very long-term project, then you can also do further fundraising but in an unincorporated JV, you cannot add more partners. So it also limits the scope of raising further finance through equity. I mean, you can take debt, but that may not always be feasible.
It depends, but brand. My understanding on this raising of funds now is very different. Why? Because if you are running a 50-50% show, practically any private equity is coming on board unless and until they have a financial interest that they would get a very high return and all that. Unless and until that is the interest, no one would want to get into this particular kind of a structure because uh, think it always from a point of view that how the VC funds look out to. They want some kind of a structure or kind of a company because let's take an example. There is one of the biggest shareholder and that's an external shareholder sitting on a cap table at a 45%, right? And there are a lot of promoters and existing shareholders remaining on the 55%. Any new private equity or venture capital coming on that cap table would think double, right? Like they would think about multiple times before investing because they would say that, boss, you have that cluster, the cap table is completely cluttered off, right? You have sitting on a number of people on the cap table, and you have one big investor sitting at 45. You have just sold off your half of the company to one guy. He would want to run the company. He would want to control the company. Where is my control in that company? So there are a lot of nuances around how we see it from a raising of funds and all that. I will not get into much of deep, but it's a very subjective thing in terms of raising of funds. I would say that.
Right. So guys, first of all, thank you, Abhishek,
Thank
for
you.
conducting such a detailed and I think a lot of insights which you have given is something which is even useful from my understanding perspective, right? In terms of structures which you have spoken about. And for that matter, guys, normally I don't do this, okay? But for this one, I'm going to share recording. So just be happy about that fact so that you can take notes in terms of suggestions and structures. And these are all very thoughtful sort of things which Abhishek has spoken about. And in case if you have any question, you can always post it on the group. You can reach out to me, or if Abhishek is fine, you can maybe reach out. I think you can reach out to me and I can pass on to Abhishek, right? So we can always have a further discussion on that. Tomorrow we will convene the session at around 4. Okay. We are going to discuss case studies in terms of the type of mergers what Abhishek has explained to you guys today, right? So we will cover 3-4 case studies in terms of that, and yeah, and then again Monday we have a session at 9. So see you guys tomorrow. Thanks once again, Abhishek.
Thank you so much, Narayan.
Thank you very much.
Thanks, guys.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank you, sir.